Hi, I'm Seth Freuberg. I'm the Director of Options Training here at SMBU. And this week we're going to be talking about the weekly credit spread, which is a very interesting trade that a lot of options traders enjoy trading. It obviously, like anything else, takes practice and should be done on small amounts of capital before you get serious about trading this for serious amounts of profit. Let me first talk about why people like to trade weekly options spreads, particularly weekly credit spreads, and that's because you get 52 bites at the apple. In the old days, options chains were only monthly, and so most people who trade option spreads traded monthly 12 times a year, and then they got their report card for the year. Well, with the weeklies, you get to trade every week, essentially. You can take weeks off, obviously, if you're going on vacation or whatever, but with a weekly credit spread, you have the opportunity during the year to trade once a week, and some people like that. However, weeklies are different. Weeklies are more dangerous. If you have a very large gap in the morning in the wrong direction, it can be expensive. And so this is not the type of trade that you can trade if you plan on playing golf a couple days a week. This is the kind of trade you pretty much need to be monitoring the trade during the day. So this is a little different from monthly trades where you can, at certain points in the trade, not necessarily be glued to your screen. This is a trade where if the market rallies from the point that you initiate the trade, you're going to win. If the market stays exactly where it is when you enter the trade, you'll win. If the market grinds down slowly, you're probably going to win as well. The place where you'll lose is a sharp down move that doesn't quit, and those weeks are going to be your losing weeks. So there's 3 of the 4 scenarios where you're going to do pretty well on this trade, and that's what makes it very attractive. It is a bullish trade. I shouldn't say a bullish trade. It's a trade that is guaranteed to do well if the market is bullish from the moment you put the trade on. So if you like to, you can use your favorite technical indicator, whatever that is, a moving average, MACD, Bollinger Bands, whatever, to make your decisions. That may heighten your opportunity to win on these trades, but that would something that you should backtest before you reach any conclusions on that. Sometimes you'll end up finding yourself taking yourself out of a good strategy by over tinkering with it and adding too many technical indicators, knocking yourself out of most trades, many of which would have been profitable. So be careful about that. And finally, for a trade like this, you want to start on a day where there's a sell-off if you can. So you probably want to start a couple weeks ahead of that weekly expiration and be looking for a day where the market's selling off, and then jump in and trade on that day because this is a put credit spread, as you're about to see, and therefore you will be paid more for the credit spread, and your strikes are probably going to be a little farther below the money, which if things settle down will heighten your chances of being able to prevail and be profitable on the trade. In terms of best practices, you want to pick a target credit. When you design your trading system with put credit spreads, pick a target credit. Some people use 5% of capital. Some number probably in that range would work. And you absolutely have to pick a maximum loss, and you have to stick to that maximum loss. Otherwise, you will not live to trade another day. Where your target profit is and your max loss is going to depend on exactly how you design the trade, but you need both and you need to stick to them. And finally, particularly for weeklies, avoid entry right before a major economic event. If it's the Thursday before a jobs report and the market's reacting intensely to jobs reports in the last 6 to 12 months, don't enter the trade the day before that. Why don't you wait for that report to come out and then enter the trade? You'll be a lot healthier that way. So let's take a look at an example. Let's go to June of 2013. Now, if you take a look at this chart here, you can see there's a 20-day moving average. line running through that chart. And so you can see the market's generally been, on the bullish side from this chart, basically from November of 2012. So if you wanted to reach a conclusion, maybe we're in a bullish mode here, you might say that we are. So now the next slide shows a typical entry on a weekly credit spread system that some people will use. You enter the short put at under 10 deltas, and then you buy the next strike down as your long strike on the credit spread. And as you can see in this case, we received a credit of $700 roughly, and that is the most you can make on the trade, is that $700. The goal here is have the market close above that short strike where you are short at the 1560 strike. As long as the market closes above that point and those options expire above 1560, both options will go out worthless and you'll be able to pocket your $700. That's the essence of the trade. Now, in this example, the day after we put it on, the market, the day of, the market actually sold off hard after we put the trade on. And so the market did exactly what we didn't want it to do. We did not want a hard sell-off at the beginning of the trade. However, we're not even down our credit yet, and usually your maximum loss is going to be some multiple of your credits because there's normally a fairly high win rate on these trades. So we're not even at our full credit yet in terms of our loss, so we're not in any kind of serious trouble on this trade. Now, the next day, the market rallied, and as a result, it actually rallied just right back to the price where we were when we entered the trade, around that 1622 area. So the market got right back up to where we started, and we're up money. Now, why is that? That is because options, credit spreads lose value every day, all other things being equal, because of the factor of time. The market has less time to get down to that short strike and give it value. So therefore, if the market just sits still, which is effectively what happened during this 2-day period, we're going to be up some money, generally speaking. Now, we then go over the weekend, and weekends are very nice on weekly credit spreads because you get 2 days of time decay. On Monday morning, by that point, the market had rallied substantially. It actually had rallied on the Friday the day before, had rallied a little bit that morning, and as a result now, we are now up most of our credit. So the question is, what do you do at this point? In the credit spread, there is now 10 cents left. Originally, we received about 70 cents per option. Now we're down to 10 cents. My personal opinion is that's the point at which you take the trade off. You've squeezed almost all of the profit out of the credit spread, close it, and be happy and wait for your next opportunity to re-enter the market. However, if you were a little silly, you would not exit. And what happened in this case was the market sold off after that sort of window of opportunity to close the trade, and we gave back some of that profit. Now, as it turns out, so much time had passed. We are now at Wednesday. We're now down to 3 days before these options expire. And as a result of that, the market is just running out of time to really give value to that short put. The market doesn't believe that there's going to be a reasonable opportunity of a 52-point sell-off in the SPX over the next couple of days. And so as a result, the market has devalued that credit spread anyway, and we end up with more than $500 of value from that spread as a result of the fact that there simply has been a passage of time, and the market's now realizing it's just not going to get down there most likely. We can't really be paying a lot of money for these puts. So the price of the put spread has been driven down. So here's the interesting thing, and this is what I call the cool part of credit spreads. Even though the market has sold off, and therefore, remember what I said in the beginning, a bullish scenario is the best. But even though we had ultimately a bearish scenario in this trade, we still were able, if we were to close this trade right on this Wednesday, even in that down mode, we would have made most of our credit. And so even though the market essentially went against the trade, because of the passage of time, we were able to make a profit. So rally, we're going to win. Market does nothing, we're going to win. Market grinds down, we're probably going to win. The one scenario where you're going to get hurt on these, and you will get hurt, and you have to prepare for that, and you have to psychologically prepare for that, is the time that the trade is very, met with a very bearish market right after it's entered. And then you just get out, you realize this is a numbers game, you get 52 bites at the apple. That particular bite had a worm in it. Most of the bites are going to be delicious. So that's our review of weekly credit spreads. Anytime you have a new strategy, you must backtest it extensively to find any flaws in the concept. Set up your target profit logically, set up your max loss logically, and then paper trade it for at least a month before you put any money into it. So first of all, backtest, paper trade, and then your first trade should be a one lot. You absolutely have to be careful, because things will come in to the execution of a trade which you will not see in a backtest and you will not see in a paper trade. So you have to learn at each stage. You're learning about the dynamics of the trade through the backtest. You're actually getting practice with the trade during paper trading, and then small capital, tiny capital live trading, you're getting a feel for the execution issues. If you go through that whole process, then you have gone through a very sound process of entering a new trading concept for you to incorporate into your trading style. So with that, I'd like to thank you very much, and I hope you've enjoyed our session today. Thank you. Thank you for watching this clip of our Options Tribe webinar. The rest of the recording is available on optionstribe.com. I'm Seth Freudberg, and I've been hosting the Options Tribe since May of 2011. We've brought in options experts from all over the world to make excellent presentations to our members. So go right now to optionstribe.com to learn more about options education, or you can send me an email at sfreudberg@smbcap.com.